Good morning, afternoon, or evening, wherever you're taking in this presentation. Thank you for joining us today for the Lytham Partners Spring 2023 Investor Conference. My name is Joe Diaz. I'm one of the managing partners of Lytham Partners. I would like to welcome Flow Beverage Corporation, a premium and sustainable water company with its emphasis on sustainably sourced, minimally processed, all-natural alkaline spring water. The ticker symbols for Flow Corporation are FLOW on the Toronto Exchange and FLWBF on the OTC. Presenting from the company today are Nicholas Reichenbach, founder and CEO, Trent McDonald, Chief Financial Officer. As a reminder, management will be available for one-on-one virtual meetings. If you would like to sign up, please visit lythampartners.com/virtual and click the one-on-one meeting request button. I would now like to turn the presentation over to Nicholas Reichenbach, Chief Executive Officer of Flow Beverage Corporation. Nicholas.
Thanks, Joe, and welcome everybody. Excited to talk to you a little bit about Flow. Flow was founded in 2014 on the back of my family owning a very large artesian mineral water spring in Ontario, Canada. It releases about 3 million liters a day of the highest quality still alkaline mineral water. And we decided to do something a little different when we wanted to commercialize the spring. We decided to put it into an eco-friendly pack made from plant-based materials. So this is all from paperboard with tree farms responsibly harvest, as well as the even cap is made out of sugar cane. So 75% biodegradable, 100% recyclable. And we launched that in 2015, where we were the only sustainable water packaged company in the world when we launched. Sustainability has been growing in the premium enhanced water category well over triple digits since the inception of the company, and now is becoming a very major category within the premium enhanced water category, with Flow being one of the top leaders and definitely the top global leader in the carton format, this is what it's considered. And currently we have 2 springs now. We acquired a spring in Virginia for all of our US customers so that we're domestically sourced and responsibly packaged out of the beautiful state of Virginia in the Shenandoah Valley. And we're located in over 51,000 retail locations across Canada and the United States. Our water is special because of its naturally occurring minerals inside the water. So we have more minerals inside our water that are naturally occurring than any other premium enhanced water brand in North America, and even international competitors like Fiji or Avion that are sold domestically in North America. And with the minerals inside, calcium and magnesium, we have 2 functional benefits, health benefits associated with drinking Flow. Number 1 is that it's naturally alkaline with a pH of 8.1. And number 2 is that it has naturally occurring electrolytes because of the magnesium salts, which gives it a very quick hydration experience similar to what a sports recovery beverage would be, like Gatorade or other beverages like that. As we briefly mentioned, Flow is a very strong ESG stock and company. We have a very large vision of displacing a lot of the single-use plastic bottles that the current industry is using for packaging water and even beautiful premium enhanced mineral water. And we have great ESG ratings, which we'll talk about, but we're the highest rated beverage company in our sustainability according to our B Corp certification, which we go through a biannual audit and rating against all of our sustainability practices, which make us the highest rating beverage company in the world, but one of the top 5% of all companies in the world. On top of that, we are a carbon neutral company. So we spend a lot of time on our supply chain to ensure that our ESG is of the highest rating, and that we are leaving the world in a better place than where we have before that. And that's flow with our sustainability. Over the course of the last 8 years, we managed to innovate in our space on top of our package by doing natural organic infusions of ingredients to enhance flavor and taste and functionality. So we have a line of products. We have 4 beautiful products that are organic certified flavors. We're the only company in the world to get organic certification on a natural mineral water with our organic flavors: cucumber mint, strawberry rose, peach, blueberry, and blackberry hibiscus. We also innovate by doing functional infusions into the water, and we have a line of organic certified vitamin water with clinically proven claims for immunity boosting with your daily dose of vitamin C and zinc with 0 sugar and 0 calories. What makes Flow very successful, we've had a very long, a very successful growth rate. The first 3 years were over 300%. The following 3 years, annual growth. And the following 3 years, we stabilized at 92%. And as I'll go on to the presentation, we're continuing our growth with above 40% growth year over year. The reason for that is that we have a very large and strong dedicated consumer base of about 18 million consumers, 3 million in Canada and 15 million in the US, growing rapidly. And this consumer is the wellness consumer, wellness woman. 75% of our customers are female, and their family. So we really focus on the health conscious, eco-friendly lifestyle of that, and we have a very strong loyal consumer base with a net promoter score of 79, which is above companies even like Netflix and Apple's and some of the brands that we know and love worldwide. Next slide. Recently, we've been doing a lot of strategic initiatives to drive the company into a profitable growth. We own 2 facilities, so we were an asset-heavy company, and investing in our own production facilities, both here in Canada, where we have a facility in Toronto that has 3 Tetra lines that is running continental, which is 7 days a week, 24 hours a day, producing our products, as well as we do co-packing products as well for other beverages that are interested in putting their products inside Tetra Paks. For the sustainability, but also for their ambient shelf-stable advantages over plastic and glass. And we also had a facility in Virginia, about 15 minutes from our spring. And in our way to drive profitable growth for Flow, we announced in November that we sold the facility for a net proceed of $19.5 million and a debt reduction of $4.6 million. We entered into a long-term co-packing relationship or co-manufacturing relationship with the new owners, Canopy Growth, BioSteel, to produce our product over multiple years so that we can still deliver our product to our US consumers from a domestic source. We still maintain the ownership of our beautiful spring, which is 144 acres in Virginia, that releases over 4 million liters a day, which would give us enough capacity to supply the entire United States as we grow into one of the top 5 enhanced water brands in that territory, as well as our Canadian facility has enough capacity to also do the entire North American market. So we've got an ample amount of sustainable water source of the high quality mineral water. We also, after the sale of Virginia, we announced that we were taking on a $20 million debt facility secured against the assets within our Toronto facility, of which we pulled $15 million to bolster our balance sheet moving forward and allow us to get on that path of profitability and do some very aggressive structuring into what we call the asset light model, which is how most beverage companies operate, which is they deal with co-packers versus their own facility. As of our last quarter, which is the Q1, January 31st, we had $26 million in cash. We announced the Flow branded products with growth rates of over 40%. Our gross margins were up to 30%, and we have massive CapEx improvements, which Trent will go into later in the presentation. As I mentioned briefly, we're located in 51,000 locations and growing rapidly, both in Canada and the US. All of the names we know and love, from Starbucks to Publix to Target to Walmart, Whole Foods, Costco. So we're broadened out both in Canada with over a 70% ACV, which is a very large penetration of all of the applicable retail locations, and 65% plus in the US in natural grocery with brands like Whole Foods and Sprouts and other leading natural grocery. And in the conventional food, drug, and mass in the US, we see rapid growth. We're at about 25 ACV. And a brand like this, over the course of a very short time, should be up to about the 65, 70 in ACV in food, drug, and mass. So we're seeing a lot of rapid growth in the US market, and we'll see that in the years to come as we invest against that core consumer, the innovation, by increasing the occasion of that consumer to consume our product, as well as fanning out across all of our leading retailers to give us maximum access to the Flow product. Next slide. As we mentioned, where our historical growth has been extremely high, but just over the last previous 4 quarters, as you can see, our average is above 35% and more like 40%, and we see no end to our growth on that level as we move forward and penetrate into the US market and fortify ourselves in Canada as the number 3, the 3rd largest premium enhanced water brand. Our latest innovation is a whole portfolio of vitamin infused lines. The vitamin infused category, for those that don't know, is largely dominated by one player, Vitamin Water, owned by Coca-Cola, that has not seen a lot of innovation over the last decade. So we've came out with the first organic certified vitamin water, vitamin infused water, with elderberry, cherry, and citrus, again, delivering immunity claims to it, as well as a beautiful tasting, no sugar, no calories, beverage, but with a very strong quality around the taste profile and using our natural mineral water. We're located in a very short time, January this year. We've already managed to locate the vitamin infused in 1,900 locations in Canada and plus 2,400 locations in the US, with leading retailers like Albertsons, Vaughn, Safeway, which is the 2nd largest grocery chain with a national rollout, Fred Meyer's, which is a Kroger division, as well as Amazon and other leading retailers in the US, as well as all of our major leading retailers in Canada like Loblaws, Whole Foods, Costco, and others. And I'll turn it over to Trent to talk about our financial highlights in 2022, as well as our Q1 and the road ahead. Take it over, Trent.
Thanks, Nicholas. Look, we want to be able to paint a picture of where we have been, but more importantly, where we're going, because we are and continue to be a company in transition. Back at October 31st for the year then ended at fiscal 22, we still at that time showed a lot of good growth in the brand, growing that year 26% for the year, and 3/4 of which were over 30%, one reaching 40. So we did have some great growth in the brand throughout the course of the year, but it was a difficult year, for a number of reasons, some of which we've talked about in operational updates since that time. We were going through a lot of cash, burning a lot of cash, large EBITDA losses, and for us, the year was a base, something from which we could propel into the future. So after the year end, which is more important, I think, than what we actually did through to October 31st, 2022, we decided, and before I talk about Q1, we decided as a leadership group, as a company, as a board of directors, that we need to do something transformative to start getting this back on track from a balance sheet perspective and the rest of the P&L underneath sales, because we have a great brand with a lot of growth, a lot of passionate consumers, and our partners in retail and e-com and other places are really behind the brand and see the velocity and the volume. And so with us, it was about, what do you do? So what we did, step one, was we looked at our two production facilities, one of which being Verona, the other in Aurora, Ontario. Verona, for us, was not operating to the degree that we would have liked, and we were able to find a good partner for whom we had done co-pack in past. Nick mentioned BioSteel, for whom we were co-packing. They came to the table and wanted to purchase that particular location. So we were able to monetize that to the tune of over $20 million, to Nicholas's point. And then what we did was also, in doing so, we alleviated ourselves of about $13 million a year in cash outflows, which we felt at the time under our management and the way the market was, that there wasn't a clear path to mitigating that cash outflow. So it did those two things, which were very positive. That still was not enough for us to be able to paint a clear picture of of our ability to get through to cash flow positivity and EBITDA positivity. So the next thing we did was we took on a piece of debt in December, which we announced. It's $20 million piece of debt, of which we drew $15 million. So if you think about those two transactions, they were very transformative in terms of the time they provided to the company in order for us to continue to do what we needed to do to stabilize the organization, strengthen the balance sheet, look for nice, clean P&L, and create that path to profitability. So they both happened in Q1. So let's go to the next slide and see what the progress was by the end of Q1. So by the end of Q1, we had again experienced the growth that we are starting to become accustomed to seeing, which we believe will continue to do into the future, a 40% year over year, Q1 to Q1. More importantly, our gross margin came up from 26 to 30 off the back of the elimination of the Verona facility and locking into a co-pack agreement with the Verona facility, the new owners being BioSteel, where we now have predictable cost of goods and don't have issues around capacity underutilization that shows up in cost of goods as overhead allocation. So those were no longer there. And so we were able to bolster our cost of goods. And more importantly, if you look at what our EBITDA was, we improved, but and it's not on the slide, but we did improve our cash flows by over 60% year over year, with massive improvements in our non-cash working capital items. And so we were starting to do a lot of the things that we said we would do. More importantly, at year end, we had at October 31st finished with $2.3 million of cash in our balance sheet. By the end of Q1, we had $26 million of cash on our balance sheet, and again have provided ourselves this timeline to continue to do other things that we expect to be even more accretive to the value of our shareholders and provide an even broader ability to get to cash flow positivity and EBITDA positive. Next slide. So this is where we get into the operational update, where we've gone and where we're going. And so again, what we've done since the year end through Q1 and Q2, now we've just started our Q3, is we were able to go and look at all of the areas of our business at a very granular level, taking in consultants and other experts in business in separate fields, whether it's IT and our entire IT ecosystem, to logistics, distribution, wholesale, or warehousing and shipping. We did almost all of our own logistics, and it's a big bucket for us. And so what we've been able to do through that process I've described is evaluate how we should be going to market versus where we are, and build out a path to get from A to B. In so doing, we've discovered that we can save ourselves at least another $7 million. On top of that, you look at the IT ecosystem we're using, license support agreements, how we were doing financial accounting, how we were doing HR, how we were doing marketing and sales. We went through every single one of our functional areas and have identified an additional amount of money. So now between that and the 13 million that we can save at Verona on an annualized basis, we expect that we are going to go from what we said to the market in early January in our operational update of $17 million a year to closer to 20 to 23 million. And quite frankly, it's on the upper end of that expectation. So all of that being said, we're now into execution mode on these things. So we expect that we're going to execute on some of those cost savings over the next quarter. And if you want to go back a slide, please. So we expect that we're going to continue to execute on those over the next quarter, and be able to see some of that annualizing by our fourth quarter. That is our expectation today. Now, that being the case, and this is where we go on to the next slide. We have been priced on the market fairly so based on a number of factors, much of which come back to this path to profitability and whether or not we were going to be a going concern, and we admit that. But that being the case, we've done what we felt was necessary to ensure stability in this organization, and to not only get stability, but to go even further. We have a wonderfully growing brand, again, a very loyal consumer, but we have a stable P&L, going to have an even more stable balance sheet, and that's where we're going. And so now you have to look at how we are valued for that type of a growth company with a stable balance sheet and prospects for EBITDA positivity. And you look at the fairly decent cross section of our peer group in the beverage sector, and the average is 3.7, is over 3.5, I believe, and the weighted average is 5.7. And so for us as a growing organization, we believe that we, at some point, when the time is right and investors catch on to the story, we do more around investor relations, there's a lot of value to unlock. We are trading at 0.3 times our trailing 12-month sales. And so for us, we believe there is that value to unlock. There's going to be a lot of work for us to do. We're going to have to prove it out, but we're on the right path. And we believe that we're going to continue on that path, and we're going to do everything we can to ensure we continue on that path. So that path is really what we've already talked about. Continue to push the brand, invest in the brand, trade marketing, in merchandising, in-store merchandising, program support, looking at sponsorships that we're doing more and more, like the National Bank Open here in Canada when we did that last year, the the New York Marathon, among many others. We work with influencers every day, and more of them. We are doing a lot to unlock the brand, and we're going to continue to do that. Innovation around vitamin water and other things that we can actually do within certain lines that we have today, like a vitamin water. The financial improvements we talked about, logistics, a huge cost for us that we are now simplifying our shipping, going into a whole restructuring cross-functionally, led by a brand new IT ecosystem that actually just went live. And it's going to simplify what we do. It's going to provide better information, more timely information, better master data, as well as save us a lot of money on ongoing license support agreements. And then there's the asset light. And while we did unlock some value by the divestiture of Verona, we do have another production facility. And that production facility is actually quite profitable for us. It's a very good profit center. It runs very efficiently, and it produces in a segment of the industry that is in very high demand that has quite a few barriers to entry. And so for us, there are a lot of people that would be very interested in an asset like that, and the value of that asset would be tremendously would be much higher than that of the Verona facility. And so we are obviously going to be investigating that as a path to asset light and what that might mean for the company and timelines and parties. And so we're going to continue to investigate that, and not saying we're pulling a trigger or not. But it is something that we will look at seriously on behalf of our investment community and shareholders in an effort to get to that path to profitability and to have the financial stability and the cash funds available to us to be able to really invest in the brand for the long term. Next slide. So with that, I'm going to turn it back to Nicholas, but this is for us based on timing and things that we've done and what we see as a continued investment in the brand and the proliferation of our sales and customer base. It is a beautiful day to invest in the future.
Boom, drop the mic. Thanks, Trent. Joe, I understand you have some questions for us. That was a great presentation. Lots of momentum.
Both your parts, great presentation. I do have a handful of questions here. Let me begin with the obvious in terms of your revenue growth rate, which has been impressive. Talk about how you can continue that 30% plus sort of streak you're on.
I mean, from the sales aspect of Flow, as we mentioned, historically, we've never had an issue with Flow. Our customers love Flow. And they like it because we're very unique in the market with the naturally occurring mineral water, artesian springs, both in Canada and the US. Sustainable packaging has never been more important. And as a result of that strong consumer intent to buy and purchasing, we're very successful at getting the premier retail locations signed against that consumer. And we'll continue to do that as we roll out. We have identified a couple key strategic areas of growth that we're investing against now. Number one is food service. It's rebounded after the wake of COVID, and it's continuing to show strong growth. But what we're noticing within food service is that the sustainability aspect of Flow has never been more important. We have partners like Starbucks in Canada, as well as NCL, Norwegian Cruise Lines, both very successful companies and brands have partnered with Flow to really build out their sustainability platform as they also grow to be a fully carbon neutral company with sustainability across all of their supply chain. So we're honored to be able to continue to build partnerships like that, as well as expand into the hospitality area with leading partners like a core hotel chain that have brands like the Ritz-Carlton, the SLS, as well as the Sofitel line. And we're located with over 6,500 rooms in North America and growing into the Caribbean and Latin America with our partnerships around premium brands and food service. And then, as Trent will remind us all, if he doesn't, I'll steal his thunder, it is the ultimate trial engine. And we're able to get our product out where you go to the Ritz-Carlton, and every day at night, they give you with 2 brand new flows for your hydration needs the following day. And people have taken on to that, as well as Starbucks and NCL, and have become our customers. And specifically our customers on e-com, where 20% of our revenue is generated by our website, flowhydration.com, and Amazon, where we do e-com delivery within 48 hours of you ordering across anywhere in Canada and the United States. We can deliver a package to you on subscription and deliver it free of delivery charge. to your household, so you don't have to lug the water over, and they become very loyal customers. And we see a very strong cohort between food service and our subscription business online. And so we're going to continue to build both of those channels as being strategic moats in that. And also the growth area that we've also seen is in the club channels, both and mass channels, both in Canada and the United States, where we have listings with Costco, as well as the dollar stores, Dollar Family, Dollar Tree, Dollar General, where we have over 15,000 of those 51,000 locations within that channel. And we're seeing above category average growth with flow. And this is the most important part, Joe, at no discounting price. So you get value pricing across leading retailers like Walmart and Costco and the dollar stores, but they're all line price. So we're not a discount brand, not moving volume on TPR, temporary price reductions. We're moving volume on repeat purchases across the mass channel. And we're really starting to see those three channels, as well as our natural grocery channels and food, drug, and mass, pick up across the board.
Well, just exciting stuff going forward. But again, looking forward here, what are the key milestones that investors should be looking forward to for the balance of this fiscal year and fiscal year 24 that ends in October 31?
Well, Trent's got this one. He loves his key milestones.
Yeah, look, it's not a normal KPI organization right now. Again, we're in transition, going from a high growth company that spent its cash in certain areas for a lot of reasons at the beginning, but those reasons no longer apply. And so we're going to asset light, and we're going to be restructuring. We're doing a lot of things. So by fourth quarter, I think what is going to be important for investors is that we're proving it out, that our SG&A is starting to come down. There's a path. You can see the SG&A coming down. You can see cost of goods starting to stabilize as you go into, say, Q1, Q2 of next year. And you have a good balance sheet where you have cash, access to cash, that in a non-dilutive manner, that we alleviate ourselves of debt and debt servicing. And I think that's what's going to be important, is that we are putting cash into the right areas, and we have that cash to put in to those correct areas. And I think that's what our investors are looking for. And they're looking for us to do more of what we're doing right here, Joe. I think investors are tired of having a thinly traded stock and not having the ability to take decent positions without impacting the value of the share price just to get in on a small position. And so we're doing a lot around investor relations, and we're doing a lot around investor outreach to produce that volume and get that momentum into the stock, to tell the story that, look, come on in today, give us a couple of years, and and then see what happens, because we believe there's a lot of upside. And as we showed on the multiples, there's reasons to believe that, when you compare us to our peer group. So I think that's what investors are looking for us to do, and we're trying our very best to deliver it.
Well, you've got a very exciting story, and I think the next few years are going to be incredibly interesting. So, Nick, Trent, thank you so much for your time today and giving us a comprehensive overview of Flow. For all of you in the audience, again, if you would like to sign up for a one-on-one meeting with the management team here, please visit lythampartners.com/virtual and check the one-on-one meeting request button. Thanks again for your time. Have a great day.
Excellent. Thanks, Joe.
Thanks, Joe.
Thank you, guys.